In 2023, a tax strategist named Garrett Gunderson ran a survey of his new clients. There were 777 of them. He found that 707 of them were overpaying on their taxes, many of them by tens of thousands of dollars a year. That means 91 out of every 100 businesses who walked in his door were leaving money on the table. Hi, I'm Mike Wright with Foresight Advisory in Indianapolis. I'm not telling you this to scare you. I'm telling you because the same pattern shows up everywhere I look. Most business owners are working with someone whose main job ended on April 15. They file your return, they check the boxes, make sure you're in compliance, and they move on. That's their job. Nobody's sitting down once a quarter, looking at your full picture and asking, what's the most tax efficient way to do what you're already about to do? Unless you're proactive, your accountant isn't, your attorney isn't, and most likely your financial planner isn't, because he or she is managing your investments. That's the work I do. And in this video, I'm going to walk you through the 5 strategies that save the most money for profitable business owners. Strategies you're probably already doing the work for, but not capturing the tax benefit of. By the end, you'll know which one is most likely to apply to you and where to go from there. These aren't the only strategies we find useful for tax, but these are the 5 that are the simplest and most neglected strategies we find to help you retain cash in your business without a lot of planning and implementation. So, strategy 1 is cost segregation. And you probably ask, what is cost segregation? Um, this is the number one. It's the one most business owners have never heard of, and it's the one with the biggest single year tax savings for the right business. The IRS lets you depreciate a commercial building over 39 years. 39. So if you bought a $2 million property, you're writing off about $51,000 a year for nearly 4 decades. The thing is, the building doesn't work that way. A parking lot doesn't last 39 years. The specialized electrical, it doesn't last 39 years. The flooring systems, the land improvements, the specialty equipment inside, none of it does. So a cost segregation study is an engineering-based analysis that breaks the building into its component parts and depreciates each part over its actual useful life, 5 years, 7 years, 15 years, not 39. Here's how it works in practice. An engineer walks through the property with a cost segregation specialist. They identify every component, land improvements, site work, parking lots, specialized electrical, plumbing, HVAC, floor coverings, decorative finishes, specialty equipment, all that's actually part of the building. Each component gets classified to the right asset class. 5-year property, 7-year property, 15-year property. The remaining structural shell stays at 39 years. The result? You accelerate depreciation on the shorter life components into the early years of ownership. Year 1, year 2, year 3, that's where the deductions land. The 39-year shell keeps depreciating on the same schedule it always did. A 78 employee metal fabrication shop we worked with had been depreciating their building the standard way for years. The study reclassified about 30% of the building. Federal tax savings in year 1 was roughly 259,000. State credit on top. The total was 400,000. The owner didn't change a single thing about the building. He just stopped treating it as a 39-year asset like it was a 39-year uniform. Here's another one. A regional manufacturing company owned $4.2 million facility. They've been in for 6 years, standard depreciation the whole time. We ran a cost segregation study, a look back study, which the IRS allows, and reclassified about 28% of the basis. The accelerated depreciation generated roughly 340K in federal deductions they could use immediately, plus catch up depreciation for the prior years they had missed. The study itself cost about $6,000. The federal deduction it unlocked was 31 times the cost of the study. Makes an appraisal sound expensive. Now, here's the part most owners don't realize. You don't have to do this in year 1. The IRS allows a look back study. If you bought a building, a commercial property in the last several years, you've been depreciating it in the standard way, you can go back, run the study, and reclassify. The deduction you missed in prior years become deductions you can use right now. That's why the strategy works for businesses that have owned their building for 2 years, 5 years, even 10 years. Almost never too late. I hate saying that, but the qualification is straightforward. You need to own commercial property, the building your business operates in, a rental property, a mixed use property. If you build it, bought it, or even significantly improved it in the last several years, cost seg study is likely worth running. And we have a preview on our website. You can run a rough view yourself. Cost studies between 3,000 and 15,000, depending on the size and the complexity of the building. Federal deduction at unlocks is typically 10 to 30 times the cost of the study. For most property owners, business owners, this is the single largest tax planning opportunity available, and almost nobody's doing it. And like I said, you can do like a quick preview. It's not the study, but we have one on our website to see if it's worth talking. Strategy two, R&D tax credits. Um, Research and development tax credits. When you hear R&D, you're probably thinking of pharmaceutical company, uh, person in a lab coat. That's not what this is. Federal R&D credit rewards everyday technical work. IRS has a four-part study to qualify an activity to be a technological in nature, involving elimination of uncertainty, require a process of experimentation, and serve a qualified purpose. So let me walk you through this because a lot of business owners miss this. Once you see it, you'll start recognizing it everywhere in your own business. Part one, technologically in nature. The work has to be grounded in hard science, engineering, applied physics, chemistry, materials science. No, you don't have to have a PhD. It's the work rooted in a technical discipline. If your team uses engineering principles to solve problems, this part is met. Part two, elimination of uncertainty. You start not knowing if your approach would work. You had a hypothesis. If we machine it this way, uh, can hold this tolerance, but you didn't know if the hypothesis would hold. That's uncertainty, and trying to resolve it is what the part of the test is looking for. Part three, process of experimentation. You iterate, you test, you refine, you test again, you adjust based on what you learn. If your team prototypes, tests, fails, adjusts, and tries again, that's experimentation of the IRS definition. Part four, qualified purpose. The work has to be aimed at developing a new or improved product, process, technical formula, or a piece of software. If you're trying to make something work better, your product work better, faster, cheaper, or more reliably, this part is met. If your business answers yes to all four, and most technical businesses do, you almost certainly qualify. Let me show you what this looks like in practice. 4 case studies from the last year. 29 employee tool and die shop in Indiana, 1.5 million in wages. The owner had been in business 22 years. It's a family operation, kind of shop that wins repeat work because they figure out what other shops can't. When I asked if his business did R&D, he laughed. We're a tool and die shop. We make parts. We're not inventing anything. I asked about the last job that gave them trouble, the one where they had to hold a tighter tolerance than they had ever held, where they iterate on the fixture 3 times, where they prototyped a custom tool path. That's every Tuesday, he said. Their credit 174K federal, 58 state, $232,000 credit first year. 78 employee metal fabrication shop Midwest, 2.2 million wages. They're doing custom fabrication work for industrial clients, solving welding problems, iterating on forming techniques, testing new material combinations. Their credit 258K federal, 177K, 435,000 in tax savings, 187 employee aerospace, 8.3 million in wages, uh, new composite layup techniques. I understand it. Testing them for FAA requirements. Basically, 100 or $863,000 in R&D credits. 800-person engineering firm, 30 million in wages. Yeah, this is going to be big. 730K federal, 325 state. They're getting $1 million in tax credits each year. Now, these are tech startups. None of them are in Silicon Valley or pharmaceuticals. They're tool and die, metal fabricators, aerospace suppliers, engineering firms. They do technical work, they just don't call it that. Um, Capturing a credit they didn't know existed. And under the one big beautiful bill, two things change that make this credit significantly more valuable. One, IRC Section 174A. You had to amortize domestic R&D costs over 5 years. After OBBBA, you can immediately expense 100% of domestic R&D costs in the year they're incurred. This is a meaningful change for any business that depends on R&D. One note, this applies to domestic. Foreign R&D still has to be capitalized and amortized over 15 years. Two, the payroll tax offset for qualifying startups. Secure 2.0 Act set the maximum 500K per year. OBBBA streamlined it. So if you're a startup with no income tax liability yet, you can use the R&D credit to offset up to 500,000 in payroll taxes annually for up to 5 years. That second point is the one most owners don't know. If you're a pre-revenue business doing technical work, you may have a credit that comes back as actual cash in the door, not just a tax liability reduction. The qualification is straightforward. You need technical employees, engineers, software developers, formulators, staff solving technical problems. If your team does work that meets the four-part test, you qualify. The credit is dollar for dollar, reduces your tax bill directly, not your taxable income, and you can claim it retroactively for the current year. Um, and and Strategy number three, bonus depreciation and Section 179. Um, they sound very similar, seem similar. These are the two tools that let you expense the full cost of equipment, vehicles, facility improvements in the year you buy them, instead of depreciating them over 5, 7, or 39 years. Let me explain how they work, because they're different tools and they layer together. Bonus depreciation is a percentage-based deduction. The One Big Beautiful Bill Act made 100% bonus depreciation permanent for qualifying property acquired after January 19, 2025. No phase down, no sunset. This is the most owner-friendly equipment writing environment in over a decade. You buy a piece of equipment for 500K, you deduct the full 500K in year one. Section 179 is a dollar limit deduction for 2026. Expensing limit is 2.5 million with phase out starting at 4 million. So you can expense up to 2.5 million in qualifying property per year. Section 179 is particularly useful for smaller purchases like equipment under $1 million, vehicles, office furniture, software, facility improvements. Here's how they layer. You use Section 179 first for the smaller items where you want more control. Then you use bonus depreciation for the rest. Together, they let you expense 100% of qualifying purchases up to several $1 million in a single year. Now, what counts is qualifying property, tangible personal property, manufacturing equipment, vehicles, machinery, tools, off-the-shelf software, qualified improvement property, interior improvements to non-residential real estate that aren't structural. Some real property improvements, if you elect to treat them as personal property. What doesn't qualify? Land, buildings. This is where cost seg comes in. Inventory you sell to customers doesn't count. Property acquired from a related party doesn't count. Regional manufacturer we worked with was planning a $2.4 million equipment refresh, CNC machines, production line, facility improvements. The previous CPA had been depreciating everything over 7 years. We moved the timing, layered in Section 179 for smaller items, used bonus depreciation for the rest, and run a cost seg on a recently purchased facility. First year deductions about $1.9 million. Same purchases, same business, just the right structure. So here's another example. Construction company with 45 employees was replacing their entire vehicle fleet, 12 trucks, in equipment trailers. This cost 1.1 million. Standard depreciation would have spread it over 5 years. Using Section 179 to expense the full amount in year one, savings was 264,000. They got the deduction the year they made the purchase, not spread across half a decade. And here's the timing piece most owners miss. Bonus depreciation, Section 179, are both use it or lose it. You have to elect them in the year you place the property in service. If you buy equipment in December and your CPA didn't elect bonus depreciation on the return, you just lost the deduction. It doesn't carry forward automatically. That's why timing matters. If you're planning major purchases in the next 12 months, equipment, vehicles, facilities, improvement, software, the structure of when you buy and how you elect matters as much as what you buy. So again, the qualification is straightforward. You need to be buying or have recently bought qualifying property, tangible personal property used in your trade or business. The deduction is most powerful in the year purchase, but look back studies can apply, like in the cost seg. But for the most part, um, it needs to be done when it's elected. So, strategy number 4: advanced retirement plans. The plan you set up years ago probably is wrong for your business you have today. Most owners I work with opened a SEP or a solo 401k when they were small. Then the business grew. The plan never changed, and sometimes they're not even contributing. So, in 2026, the right structure matters. Solo 401k caps owners at 72,000 to 80,000, 83 with catch up, with the super catch up. This is the baseline. If you're a solo owner or you and your spouse are the only participants, this is where you start. A safe harbor 401k with cross-tested allocations can push that to 85,000 to 100,000 plus. Safe harbor means the plan automatically passes IRS non-discrimination tests. You don't have to worry about whether you're favoring owners over employees. Cross-testing means you can allocate more to the owners based on age and compensation within the IRS limits. This is where your owners with 5 to 20 employees should be. A cash balance pension plan layered on the top can reach the IRS limit of $290,000 a year. Cash balance plans are age weighted, so a 60-year-old can contribute a lot more than a 40-year-old. They're technically defined benefit plans, but they operate more like 401ks from the participant's perspective. The contribution goes in, it grows, it comes out at retirement. The magic is in the layering. You can have a solo 401k or a safe harbor 401k as the base, then layer a cash balance plan on top. The combined contribution limit for owners in 50s and 60s can exceed 200 to 300,000 per year, all deductible to the business. 12-person professional firm uh, came with a 401k, vanilla 401k. Owner contribution was 30K. We redesigned it with a safe harbor structure. The new limit was 85,000 plus, same cash flow from the business, 55K more in deductions per year. That's a six-figure tax difference compounded over a decade. So here's another example. 55-year-old owner of a 30-employee manufacturing company had a solo 401k initially, um, changed it to a safe harbor 401k for the employees and layered a cash balance pension plan on top. New owner contribution limit, $240,000 a year, 173,000 more in deductions annually than what he was doing before. And over 5 years, that's 865,000 additional deductions from restructuring the retirement plan. It goes into the retirement plan. Here's the most things owners don't think about. These contributions are deductible. So if you're in a 32% combined Fed and state tax bracket, a $200,000 contribution saves you $64,000 that year. The money grows into your retirement account. You just get to keep more of it up front. The qualification depends on the plan type. Solo 401k, you and possibly your spouse are the only participants. Safe harbor 401k, you have W-2 employees and you're willing to make mandatory contributions on their behalf, usually 3 to 4% of their compensation. Cash balance pension, you have your business needs stable cash flow and you're committed to annual contributions for 3 to 5 years. The right plan at the right stage of business can add six figures to your annual deductions, and most owners are sitting on a plan that's too small for their business that they're actually running today. Strategy number five, entity structure and QBI. And this is a quick overview of these topics because the devil's in the details of your business. But entity structure and the Section 199A QBI deduction. The S Corp that you likely elected in year two is probably wrong for your business you have today. Here's why. The QBI deduction is worth up to 20% of your qualified business income. For 2026, the income threshold where phase out begins is 403,500 for married filed joint, 201,750 single. Um, there's a phase in ceiling at 553 and 276. Okay. Deduction can evaporate entirely. Let me explain how QBI actually works because most owners misunderstand it. QBI stands for Qualified Business Income. It's the net income from your pass-through entity, your S corp, your partnership, sole proprietor. The Section 199A deduction lets you deduct up to 20% of that income for your personal return, separate from your business deductions. But there are limits. Above the income thresholds, the deduction phases out based on two factors. Whether your business is specified service trade or business, SSTB, and whether you pay W 2 wages or have qualified property. SSTBs include health, law, accounting, consulting, financial services, and any business where the primary value is the reputation or skill of the employees. If you're above the threshold and running an SSTB, the deduction can disappear entirely. If you're not an SSTB, the deduction phases out based on W-2 wages paid and your qualified property. The simplified version is you need to be paying a reasonable W-2 wages to non-owners and significant business property. S corps and partnerships can structure around this. Sole partner proprietors and single member LLCs usually can't. Most pass-through owners I've worked with either missing the deduction entirely, claiming it incorrectly, or structurally their entity in a way that disqualifies them at higher income levels. The fix is usually a structure review, not a tax return change. So a consulting firm doing 1.8 million in net income came to us structured as a single member LLC. The owner had been taking distributions, paying self-employment taxes on the max amount. We restructured it to an S corp with a reasonable salary, no joking or no monkey business. Layered a QBI, added cash balance plan, saved him 87K per year. Same revenue, same owner, different structure. Another example: law firm, 8 attorneys, partnership, 4 equity partners, taking 400K annually in distributions. They're above the QBI threshold. The deduction was phasing out because they weren't paying enough W 2 wages to non owners. We restructured the partnership agreement, adjusted the compensation model, and added a defined benefit plan. Annual tax savings 215,000 across the partnership, so 50K plus a piece. And here's the entity piece most owners miss. The S corp you elected in year two have been right when you're doing 500K, but at 2 million, 5 million, 10 million, the structure that worked at a small scale often creates tax problems at scale. Self-employment tax, exposure, QBI phase outs, reasonable compensation challenges, loss of the deduction entirely. Qualification for QBI is straightforward. You need to be a pass-through entity, an S corp, partnership, sole proprietor, single member LLC. Savings is dependent on your income level, entity type, W 2 wages paid, and whether you're an SSTB. The fix is almost a structure, almost always a structure review, not a tax return, not a new deduction. A look at how your entity is organized, how income flows, whether the structure you have today matches the business that you're actually running today. So, in closing, those are the 5 strategies that most miss: cost segregation, R&D credits, bonus depreciation, Section 179, advanced retirement plans, entity structure, and QBI. For most profitable business owners, at least 2 of these apply. For the right businesses, all 5 do. Savings can range from 50,000 to 400,000 a year or more each year, depending on your size, structure, and what you're already doing. Question isn't whether these strategies exist. They do. And there's the question is which one applies to you and what's it worth? I built a 3-minute tax check that walks you through the same questions I'd ask in a discovery call. At the end, you'll know which of the 5 strategies most likely to put real money back in your pocket this year. There's no commitment, no call required. The link is below the video. Just take 3 minutes. You see what you qualify for. I'm Mike Wright with Foresight in Indianapolis. Thank you for watching and have a great day.